right into diving into the FRX Beginners Bootcamp Part 4. So I hope everybody's absolutely ready for this. I hope you guys took notes on the previous sessions, so that way we can go ahead and get this thing absolutely rocking and rolling. All righty. Now, let's try to get this thing going. So if the volume is low, just go ahead and put up the volume right on your microphone. This is the best that I can do without the broadcast getting interrupted. All right, let me try one more time. All right, maybe we can work with the volume setting like this. All right, and with that being said, we're gonna go ahead and we're gonna get this thing rocking and rolling. So good morning to everybody. All righty, so today we're gonna begin with FRX Bootcamp number 4, and we're gonna start off with what is price action. All right, now before we go ahead and we dive into today's Beginners Bootcamp, on our previous bootcamp, we spoke a lot about the concept of market structure, understanding how highs and lows create a formation within the market that allows us to help us read and interpret market prices to create predictions for future movements, and how also the market structure helps us assess trends within the market. So today we're going to be diving a lot deeper into that market structure concept, introducing new elements through what is known as price action. So let's begin with this. Price action is a method of trading that allows a trader to read the market and make subjective trading decisions like market structure based on the recent and actual price movements to generate signals of entries and exits in the market that stands out for its reliability and not for requiring the use of indicators. So again, price action is reading the raw price and generating signals of entries and exit without the use of indicators. Now, price action includes the understanding of the following: highs and lows inside of the market, which is the market structure, support and resistance levels, which comes in very many variations: support and resistance, supply and demand, quarter levels, key levels, so on and so forth. And for the basis of this training, we'll stick to the support and resistance model and concept. Also, the interpretation of trends in the market and a variety of price movement concepts. Now, price movement concepts, you can look at that as an interpretation of strategy trading. As you begin to dive deeper in the I Am Mastery Academy, whether you're trading with me or another educator, you'll notice that educators interpret price differently. And based on how they interpret price and price movement, they're able to develop strategies. They'll give these strategies names, or these strategies will have predetermined names. And again, how they use this will determine their strategy. So there is a variety of price movement concepts that fall into the price action model. Now, the better that you get at interpreting price action, which is the highs and the lows, the support and resistance, and the trend levels, will really help determine how well you're understanding the market and how well you can interpret price movements in the future. Now, just remember this before we move on: price action is as old as it is popular. Your future in trading will heavily depend on how well you know this. So let's take a look at this model before moving forward. As we can see over here, we have a series of highs and lows. We have the market set at a low, market setting at a high, market pulling back down to a higher low. Again, this is a higher low because this low point is higher than the previous low. We see that the market moves back up and creates something known as an equal high. An equal high is when price runs into a previous high and it does not go any higher. Price from here begins to fail and come back down, creating an equal low. Price running into this previous higher low and holding before reversing creates this equal low. And as long as price stays within this range, This is what we consider a ranging market. Support and resistance, as discussed in our previous masterclass. As price begins to break the previous high and set a new high, we're now determining the trend in the market according to the market structure rules. As we see here, market pulls back down, creating a new higher low, continuing that series of uptrends, giving us equal highs and equal lows in a ranging and consolidating market before the market continues to create new highs and potentially continues this uptrend. This is exactly what your eyes needs to see and what your mind needs to understand at any given moment's notice for you to really master the concept of market structure. So now that we could dive deeper into price action. So being that we spoke about trends on our previous masterclass, on our previous Forex Beginners Bootcamp, we're going to continue this one talking about support and resistance levels. So let's begin by reading what we see here on the screen. Support and resistance are used by traders to refer to price levels on the chart that prevent price from pushing in certain directions, often viewed as points where price may stop and reverse. These levels are denoted, which means identified by multiple touches of a price level without breaking through. Now, we spoke about in a previous masterclass how we use highs and low swing points in the market to help us determine where we can identify support and resistance levels. But as we get a little bit deeper, you might notice there are some traders that might want to trade support and resistance, or maybe if you're trading on the HFX package and you're scalping, or maybe you're trading, commodities or oils or cryptocurrencies, and you're in a big ranging market and you want to be able to trade those highs and the lows. You want to trade that sideways market, right? Support and resistance, let's read this here again, often viewed as points where price may stop and reverse. So once we have designated a resistance area and a support area, these support and resistance areas are viewed as areas where price may stop and then reverse, potentially giving us a new opportunity to trade in the market. Now, reading again, these levels are denoted or identified by multiple touches of price, by multiple touches of a price level without breaking through, meaning that a support is not simply established, or a solid support or resistance level is not simply established by simply one touch, but by multiple touches in a particular price zone. And we're going to be getting heavier into that concept. So let's talk about the concept of support and resistance. Support is placed below price, if that's not already obvious, right? Meaning that if price creates low points or higher low points, a support would be considered the ground below that low point, which is why we have the blue level here. Resistance is placed above price, which means that if price has fell down to this level of support and is now making its way back up, it is making its way back up to a resistance, which is the roof or the ceiling. Very, very simple concepts, right? Support and resistance is relative to price. Now, this is extremely important. Support and resistance is relative to price, meaning that support and resistance levels are only support and resistance levels compared to the position of price, meaning that if price is above this low, this is a support. If price is below this high, it's considered a resistance. Now, price will not stay in this zone forever. Eventually, price is going to break through to the resistance, creating new highs. Now, by the market creating that new high, this previous level of resistance now becomes the new level of acting support. So you see, once resistance is now support, and the only thing that has changed is where price is. Because price is now above this previous resistance, this is now considered a new support inside of the market. All righty. So right then and there, let's understand that support and resistance is relative to price inside of the market. Now, advanced traders view it as structure levels, all right? So many traders, you may hear them say support and resistance to be able to simplify the terminology, to be able to simplify what they're saying to you so you can understand it. But as you get deeper in trading within the market, many advanced traders just consider it structure levels. That's it. Support and resistance are levels of structure. Why is that? Because as you're trading market structure, as you're trading the lows and the highs and so on and so forth inside of the market, right over here, okay, pardon me, I'm just moving around my mic. So as you're trading the levels of, as you're trading the highs and the lows inside of the market, you're simply looking to see where price is moving. So you're just putting these levels of structure, all righty? Which gains and loses strength based on the number of hits to a zone. So meaning that if we have structure levels or if we have quote unquote support and resistance levels, traders may identify that these zones are strong if they have several hits to a specific zone. Like as we see this level of support and resistance has 1, 2, 3, 4 hits at this particular zone. So a trader may say, hey, this level of structure is very valid. It's very strong. It has multiple touches and price rejections at that specific price level. So this is a support or resistance that I may want to pay attention to more than the others. Now, on the same hand, if price is continuing to hit this level of support and resistance, they may look at it as now losing strength, where you can look at price being a jackhammer. So if a jackhammer continues to pound the ground, bing, 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 what's happening? It's now chipping through that ground, breaking the foundation, and eventually that jackhammer may break through. So this is another way where traders may identify if a level is strong or when a level is getting weak. And you'll be able to have a better understanding of that as you get deeper into the price action theory and concept, and you're learning new concepts as well. Now, please remember that trends work hand in hand with support and resistance levels, basically visually carrying price into new trading zones. Okay, so let's take our first view at the market and let's take a look at some support and resistance levels and how price and how trends may be carrying this into new trading zones before we move on. So let's come over here and let's take a look. We're going to be looking at Euro Chef. We're on the 15-minute time frame currently. All righty, and we have a lot going on in the market. We're going to be breaking down several points in this chart, but let's take a look over here. Now, if we take a look over here, we can see levels of support and we can see levels of resistance, which are those swing lows and those swing highs in the market. Now we see the market swings back low, breaks through, creating these new high points, creates a high, and we have price coming back down to a level of support. And then we see one more time, price makes another push to a high point before eventually reversing. Now, if we look at these levels of support and resistance here inside the market, right, what do we ultimately see? We ultimately see that price is in fact in an uptrend. So as we can see here, just looking at the market structure, let's mark this up. Looking at the lows, the highs, the lows, the higher highs, the higher lows, the higher highs. We can see that the market structure and the trend is in fact bullish, but look at how the support and resistance helps us understand the zones and how price is trading up. Okay, and we can see this in multiple different parts of the market. As we take a look and we tend to look at more price levels, we can see market lows, market highs, which become market lows, market highs, price breaks out of that zone, market highs, market lows, price going higher, creating new highs, creating new lows, which are retesting these lows, right? And then just following these concepts of price. So you see how we're able to identify these levels of support and resistance inside of the market. And all it's essentially doing is just carrying price, carrying the trends up into new levels of price. That's it, okay? So very, very, very good for us to use support and resistance and use trends in the same hand. Now, moving forward, let's talk about the concept of pullbacks and retracements. Now, we're going to be getting deeper into support and resistance as we go deeper through today's lesson. Now, let's talk about pullbacks and retracements. Now, you may have heard me say a pullback or retracement sometime during this training or maybe in our previous trainings, and maybe it didn't quite click to you. So let's talk about what actually is a pullback and what's a retracement. So a pullback is a pause or moderate drop on a price chart from a recent peak that occurs within a continuing uptrend. As an example, let's say the trend starts here. The trend is now breaking a previous level of resistance, becoming the new support, creating a new high, becoming the resistance. And in one swift motion, the market is simply just pulling back before continuing its uptrend and going in an upwards direction. So let's come on over here. Let me get rid of this. Let's remove these drawing tools and let's take a look over here. Okay, let's look at this market over here. So let's draw up this level of support. Okay, let's draw up this level of resistance or these structure levels that we can see right over here. Now, what you can see is the markets initially begins to make a rally, begins to make a run up, breaking these previous highs, predetermining to us traders that the market may want to continue to be bullish. And what we can see here is we see a few candles giving us a swift move, pulling right back down. This is what is considered a pullback before the market continues its direction in the trend. Okay, that's a pullback right over there. Now, if we talk about a retracement is a short-term price reversal in the major price trend. The retracement does not last for long before the trend resumes its original direction. So as we see here, this is a swift pullback, several candles pulling right back down. Now, if we look at a counter trend, again, we're going to read this. If we look at a counter trend, aka a retracement is a short-term price reversal. Remember, what signifies a price reversal? A price reversal is when the market begins to make opposite highs and lows, makes highs and lows in the opposite direction of the trend. That's a price reversal according to our market structure rules. The retracement does not last long before the trend resumes its original direction. So as we can see here, the price is making a series of lows, lower highs, lower lows, lower highs, lower lows, pulling back down, whether it's to a new level of support or a trend or whatever it pulls back down to, before eventually stopping and resuming its direction in an uptrend. Let's come on over here at the market and let's take a look at the difference of this pullback to this counter trend right over here. Now, as we see, once the market made a resistance, the market started making a series of lower lows and lower highs in the market right over here, running right back into this level of support and resistance, okay? Before, again, still ranging, before continuing the trend in the up direction. This right here is what we would consider, let's go ahead and delete all those lines so it's not too choppy. This right here is what we would consider a counter trend or a pullback in the market. Where if you drop this down, let's say on a lower time frame, right? Let's come over here. If we drop this down on a lower time frame, pardon me, where if we drop that down back on the lower time frame, again, let's continue to analyze. Swift candles simply pulling back down before the market continues in this trend. Whereas over here, let's look at the resistance. Whereas over here, the structure is reversing, right? Let's take a look. Okay, let's take a look. Over here, we can see the market is making, let's dot this up. We can see the market is going low, high, low, higher high, higher low, higher high, higher low, right? We can see, in fact, that this market is moving on an uptrend until ranging and consolidating, price actually bottling up over here. And then at one point, bingo, the structure begins to reverse. Market breaks that previous low. So we have high, low, lower high. Market fails to make new highs, breaking that previous high. Market makes new lower low. Bingo, we're now starting to have that market structure reversal. And look what happens right over here on a lower time frame. Okay, in case it's difficult to see on that 15-minute, and the price begins to range right over here, staying in this area before ultimately breaking out. So we see how the market was uptrending here, began to move sideways, and then created highs and lows in the opposite direction. All righty, ladies and gentlemen, this is a market structure reversal. This right here is where the market structure reversal took place on a lower time frame and began to pull back down, creating that downtrend. Right now, as we come back over here, you'll see that counter trends are often considered retracements. So many a times where you see the market pulling back down, counter trending, pulling back down, retracing, many traders consider this known as a counter trend. Now, counter trends can very well confuse traders who are not experienced in price action, can confuse traders and make them believe that the market may in fact be in a new downtrend. And this is where traders begin to get confused, which is why it's very important that you're understanding your ranges, your highs, your lows, and the levels that you're trading in the market. As we progress through this boot camp and through future boot camps, you're going to be able to learn how to identify ranges and zones on higher time frames to trade with the overall direction of the trend. So you can learn the difference of what's a pullback and what's a retracement, opposed to what's an actual trend reversal and market structure reversal on a larger time frame. Now, moving forward, let's talk about what is a break and retest. All righty. Now we're beginning to dive deeper. Okay. As the market pulls back or retraces pulls back and retraces before continuing its trend, this concept to many traders, can also signify something known as a break and retest inside of the market. So let's dive into this. A break and retest refers to price reversing direction after a break in price, which is the current high or low, that current zone or range, and returning to the breakout level to see if it will hold. Now, there are two forms of break and retest. You can have a break and retest to a zone, which is ideal, or a range, or you can have a break and retest of a trend, which is subjective. Now, before we get into a break and retest of a trend, which is subjective, we're going to talk about the ideal break and retest of a zone. Let's begin by looking at the price model over here, and then we'll go over to the actual live market. Now, family, give me just 1 second over here. Okay. Now, coming back to the diagram, to the diagram right over here, let's take a look. Remember, the black line represents price. Now, we could see that the price goes from swing low to swing high, creating our pivots. And from here, the market pulls back down, creating a higher low, basically establishing a potential trend inside of the market. So that green line is the trend. Remember, if you're going to create a trend line, which are subjective, you create a trend line by connecting the first 2 points in the direction of the market. So this is creating a low and a higher low. And now we use that to create a potential uptrend. Now we can see that price is within this range. There goes the resistance, there goes the support or the 2 structure levels, and price is in this zone. Now, a breakout, again, as discussed, a breakout is when a price or a candle breaks and closes above the zone or the range's highest candle. Now, when the market breaks out of a previous zone, let's actually come right over here to the market. Let's remove these drawing tools. Let's come back over here. Okay, let's say this is the high and we have the low right over there. Okay, bingo. What we're looking for, okay, what we're looking for is we're looking for price to break above. Remember, this is the high and that's the low. So in order for price to break out of this range and signify where it's going to go next, we need a candle to break above that price level. Pardon me. We need price to break above and close above that price level to signify that there is a break in this range, right? Which is what we see here. That's the yellow point. Now, as the price breaks out in that range and establishes its new high, it's going to go as high as it needs to go. It's going to establish that high. And then the market is going to eventually retest and pull back, right? Or counter trend or retrace. It's going to pull back to some point in the market. And we're going to get into that next. And from there, it's going to retest that previous level of structure. And by retesting that previous level of structure, this can help traders identify potential entry points in the market or help traders identify if the trend is going to continue in that direction. Okay, remember, a break and retest refers to price reversing direction. It breaks out, reverses direction. Okay. Returning to the breakout level. This was the breakout level to see if that level will in fact hold before resuming its direction. So as we can see over here, we're looking for the price. Pardon me. Let's get a 1, 2, 3, which is not here. So we'll just do an ABC. Pardon me. Let's retry that. There we go. So we see price breaks. Price looks to retest that previous level of structure and then continue in the direction of the market. And we'll just make that blue since it's a bullish retest. All right. That's a break and retest. All righty. Which is ideal, wanting to see the break and retest of the zone. Now, the second type of break and retest is to a trend line. And this is very, very subjective, okay, which is a break and retest to a trend line. So let's come on over and then let's talk about a break and retest to a potential trend line in the market or to several trend lines in the market here. So if we come over here, let's do this smaller time frame and then we'll look at a bigger one. So if we come here, we can take these first 2 points inside of the market. We have 0.1 and 0.2. And again, trends are subjective because you may want to use it here. You may want to use it here, right? So let's say we just take the very first 2 points of price rejection. We push this market out right over there and bingo, there we are. Now, what we can see over here is that price also at this particular level, we can see that price now broke below the trend, retesting the trend level before moving down in a downwards direction. You'll see many traders attempt to trade the break and retest of a trend line as well, okay? And this can be very powerful. So if you see trends or counter trends will form, or let's say you want to do something like that, there we go. A counter trend will form, a trader will have one hit and two hits looking at that. And then they're going to say, okay, I want to see the break and the retest, breakout and retest of that trend before continuing the uptrend inside of the market. So you see how the market broke and retest this trend here. Okay. Again, it's subjective, but break and retest of trend lines can be extremely powerful. But you should use it in conjunction to the break and retest of a zone. So if you're going to break and retest a trend, also look to do the break and retest of a zone, use it in conjunction and use it together. Why is that? Why is that? It's because pullback and retracement have different retest levels. And this is what we're going to get into. There are 4 type of retest levels that are inside of the market. So if you're simply trading the trend before we get back into the zone, if you're simply trading the trend, let's come on over and let's look for a different type of trend in the market. All right, let's say we want to use, this trend right over here. Okay, let's say we're doing this. Let's use the first 2 points, which again is 0.1 and 0.2. Now, here goes the subjectiveness of a trend. Now, if you wanted to trade the breakout and retest of a trend, look at how many times, once the market broke out the trend, look at how it returned to the trend once, twice, 3, 4 times, kind of broke back in before ultimately hitting this peak and then the market reversing right over there. So you see, in this example, if you try to trade the breakout of the trend, you would have been in major trouble, as this would have had the market pull back well over 20 pips over the course of 17 hours and 30 minutes. Nobody wants that as a trader, okay? But you'll see in this example how this break and retest ended up working out perfectly. So you see how the break and retest of trends are subjective. So you want to use it in conjunction with the break and retest of a zone, which is the ideal area of where you want to find the break and retest. Now, again, in conjunction means together. So ideally look for, right, in a simple term, look for, let's say you're drawing up a support and resistance level in the market right over here, okay? Without even knowing about any of the rules, look at how the market here broke this previous high and retest this previous high at the same time that it broke this trend and retested this trend. So you see how at the same exact time on a very, this is a very simple concept. It broke and retest the zone and it broke and retest the trend at the same time. That's the easiest way as a new trader for you to be able to identify, valid forms of break and retest in the market. But let's get a little bit deeper, okay? Because we are going to be diving deep into these price action concepts to have you guys fully prepared to trade in the market with me or with other educators and using other strategies. So let's talk about the pullback and retracement levels inside of the market. Okay, it says that my screen is zoomed in. Okay, so give me one moment. I don't mean to break off of this. Let me come over here. Let's look at this OBS. And you are right. The screen is zoomed in. All right, let me try something over here. Give me one moment. This may cause my computer to freeze, but let's see if this is just a little bit better now. There we go. Now you guys should be able to see my screen in its entirety. All right. I sincerely apologize for that, ladies and gentlemen. I hope it did not disrupt your education. So that way we can continue in the market right over here. All right. Now, moving forward, okay, let's talk about the pullback, retracement, retest levels. As we began to state that there are 4 different type of pullbacks. So the first pullback, retracement, retest level is known as a shallow retest. This is where the market may retest about 1/3 of the breakout. Okay, it may retest about 1/3 of the breakout, typically not returning to the retest level. Okay, so if we come over here, let's remove these drawing tools. And then let me see if I can find some break and retest concepts. So let's see right over here, okay? As we can see at this low, we had a market low and we had a market high right over here. Okay, we had a market low, we had a market high. Now this is a poor example. We're gonna use other examples. But here, let's say the market broke out the previous high. My computer's already lagging, so simply bear with me, ladies and gentlemen. Okay, give me 1 second. I believe I'm just having an issue. There we go. Okay, we can see the market broke the previous high. It didn't give us a big run up. So many people would not really look to trade a retest. But in this example, let's just stay. From here, the market in fact pulled down. Now guys, give me 1 moment because this thing is give me 1 second as this market is in fact as this computer is just like my cables got a little bit damaged. So give me 1 moment. As this begins to load, it's going to start increasing the CPU of my computer, which is going to cause it to lag. So give me 1 moment as everything just refreshes and reloads inside of the market. All right, ladies and gentlemen, just give me about 2 seconds here. Let everything reset, and then we can continue our training. All right, there we go. All right. So as we see here, the market broke the high and pulled back down. Now, as we can see right over here, or as a matter of fact, we can even use this level down here. Let's use this level. This might be a more ideal level. Let's look at this high and low in the markets right over there. Let's say this was the break. Okay. Give me 1 moment. Let's get rid of this. Okay. There we go. All righty. So let's say this was the resistance, that was the support, and let's say this was your trading range. The market breaks out the high, giving you a nice run, indicating to us new higher highs in the market. Again, going above this previous high, going above this previous high. The market is now setting those new higher highs, signaling a potential uptrend. So now you're waiting for the market to retest to give you a new low point, a new opportunity to enter to take that market up. Now, this would be considered a shallow retracement. So I'm going to take this Fibonacci tool, which you will learn in our next masterclass, and I'm going to go from the low to the high right up here, and let's see what this retracement level was. Pardon the lag. Okay. There we go. So from low to high, we can see that this market retraced about 1/3. It did not return to the last high where the market broke out. It created a new high. It did not return to the breakout level. It only retraced about 1/3 of the move before continuing its uptrend. This is what we consider a shallow breakout inside of the market. You can see shallow breakouts many, many times within the market, depending on which level you're trading in the market. Now, the second type of breakout is known as a standard breakout. Okay. Okay, give me 1 second because this thing is just testing me right now. All right, there we go. Okay. Now, the second one is a standard breakout. Okay. A standard breakout is where the market is, where the retest is retesting the breakout's level. Meaning, let's say we come over here, the exact price level where the market broke out, the market will create a new high and then pull back or retrace back to that actual price level, okay, before returning and resuming its uptrend. Now, a standard retest can retest anywhere from 1/3 to 2/3 of its initial move. 1/3 to 2/3 of its initial move, retesting that previous level. So let's come back over here to the market and let's look at, pardon the lag. Oof. Okay, retesting that. Now, guys, I do want to continue the education, but again, a new level, a new devil. We've been trading together for years. We never have issues training or educating or lags or anything in the market, but suddenly we drop a new Forex bootcamp and there we go. Dozens of lags to throw me off of my mix, to prevent you guys getting the education that you guys deserve. So just give me one moment over here. Give me just 1 second, family. Okay. I just need this computer to respond when I need it to respond. Okay. Because we have lots of market examples to go through, and we cannot go through these market examples with this type of computer lag. All right. So let's move this on over. Let's move this on over so we can get back to our previous examples. All right. Just a few more seconds, ladies and gentlemen. Pardon the lag. Give me just a moment. Let me try something here on my computer. See if this helps out. Okay. So there we are. Let's try to come back over here. Wow, this thing is really, really, really trying to make me lose my composure. So let's come over here. Okay, let's come over here. All right, and let's try this. All right. All right, this is not going to work. Ladies and gentlemen, just give me one more second. Whew. Okay, guys, let me try something over here. I'm going to try my laptop display. Okay, let's transform. Okay, let me see if I can somehow do this correctly. Full screen scaling order. I want to fit to screen. Okay, edit, transform over here. Position top left. All right, let's try a new. Guys, give me just one moment over here. It's like, this is bugging me to a maximum that we have to even deal with this. Ooh. All right, there we go. All right, we should be good to go now. Ladies and gentlemen, I sincerely apologize for that delay. Give me just a moment right over here. Okay. All right, there we go. All righty, so moving forward over here, ladies and gentlemen. All right, so pullback and retracements here within the market. So there are four types. Type number one is a shallow pullback inside of the market, which is that 1/3. And the standard pullback is a retest breakout level of 1/3 to 2/3. Now we come right over here. Let's take a look over here. So let's look where the market has that initial high. The market has this initial low right over here. And what are we going to look for? Let's look for the breakout in price. Now you have that breakout and you have this breakout. So let's just look for the entire breakout back on the 15-minute. All right. There goes the initial breakout. And then let's take a look at how when price pulls back, retraces, or retests this previous price level right over here. Now I'm going to create a zone or a range right over there. There we go. So now when price pulls back to this specific level, what we're going to do is we're going to use our Fibonacci tool from low to high. Okay. And we can see, well, this actually gave us a shallow pullback, but this in fact retested. Let's come back over here. Not a shallow pullback. It gave us a shallow pullback. Pardon me, I'm a little disoriented. Okay, the standard break and retest is 1/3 to 2/3 of the level. Okay, 1/3 is again that 38.2. 2/3 is the 618 right down there. All righty, so we have 1/3 to 2/3, which means that this entire zone can be the pullback level. Now, many a times you'll see that 50% is really that key area. So you're looking anywhere between 1/3 to 2/3. So anywhere within this area, we can see it pulled back to the 1/3 level. We can see it pull back to the middle, to that 50%, before resuming its uptrend. And one more time, as stated, you're going to learn about the Fibonacci's and certain indications on our next FRX Beginners Bootcamp. But for now, let's just stick to the levels that it can pull back. So while it will pull back to 1/3 or 2/3 of the initial breakout move, one of the key features here is that it will retest the actual breakout level. And that's what's happening here. It's retesting the breakout level. If we take a look over here, when the market cleared these highs, creating a new high, it pulled back, retesting that actual level in price, right? Retesting the breakout level. Now, moving forward, the third type of retest is a deep retest. Okay, this is where the market may retest something known as a fair value gap, also known as an FVG. Now, a fair value gap really dives deeper into understanding of liquidity in the market and how the banks are balancing their books. So I'm going to quickly introduce that concept to you. But a deep retest is where the market may retrace about 3/4 of the initial move, okay? Basically going deeper than the actual retest level. So one more time, a shallow retest is where the market is not necessarily retesting the breakout level. It's about 1/3, resuming its trend. The standard breakout level is where the market is actually retesting the breakout level anywhere between 1/3 to 2/3 of the initial move. The deep retest to the fair value gap, or the FVG, is where it comes lower than the retest level, than the break level, to about 3/4 of the way before resuming its uptrend. Now, coming back over to the market, we have a potential deep retracement taking place right over here. So let's take a look at this market. So we take a look at this market, we can see the market low and we can see the market high right over here, okay? Now, in addition, let's go ahead, let's get rid of those zones so that way nothing is distracting us, okay? Now, we can see here that this market has, in fact, pulled up, breaking these previous highs, indicating to us that we want to create a new uptrend. And now the market is pulling back. Again, this is more of a pullback and not a retracement because it's just several candles in one direction. A shallow pullback where it would be if the market would to come, let's say right over here from low to high. The shallow pullback is where if the market comes around 1/3, anywhere between 1/3 and 1/4, right over there, that would be a shallow pullback. A standard pullback would be if the market were to pull back to the actual breakout level, anywhere between 1/3 and 2/3 of this move. And now going into a deep retracement, this is where the market breaks past the actual breakout level, looking to go down about 3/4 of the way, about 75% to about that 79% right down here on the Fibonacci area. This right here would be considered a deep retracement inside of the market. Now, if you're asking, you're saying, well, what would cause the market to have a deep retracement like that inside of the market? Now, let me get rid of the Fibonacci's as we can see the deep retracement level. So what would cause a deep retracement in the market is understanding something known as order flow, right? Or institutional order flow inside of the market. Basically meaning that once the market has broken this high and came up here, this is indicating to us that the banks want to push the market higher. So traders of all levels, scalpers, day traders, swing traders, position traders, right? Depending on where they're entering the market, right? We have all been alerted. We can all see, we can all identify unanimously that this market is now making an uptrend. And what happens is in this area of consolidation, this area of accumulation, there were way too many people that decided to place buy orders inside of the market. So it wasn't like this short move where, you know, scalpers are looking for a break and retest on the 5-minute, or maybe day traders are looking for a break and retest on an hourly chart or something like that, or swing traders are looking for a break and retest on a 4-hour, right? Everybody can see this part. And what's happening is the banks do not want traders to trade with them. They do not want that to happen. The bank's job is to beat us in a game of, this is what they say. They say in a game of the bulls and the bears, the pigs get slaughtered. So what's essentially happening is that everybody is buying up. Now you have everybody jumping into this market. Everybody's expecting this market to take off. And the banks are saying, okay, well, those of you that are in a buy, let's come over here. Those of you that are in a buy and looking to buy that shallow retracement, we're going to take you out and drop the market lower. Those of you that are going to blindly enter in a standard retracement right here in the market, we're going to push this market down. We're going to blow your account. We're going to pick up all of your orders. We're going to drop the market as deep as we can, deep as we can, to balance the books. So they want to be able to get out as many people as possible from this trade. So that way, when they push the market back in the direction we already know it's going, 95 to 99% of traders are out of the trade. Okay. So this is the reason, this is the psychological or the algorithmic reason why there may be a deep retracement inside of the market. All righty. And a good way to find that is to simply look for the entire move from low to high and mark up that 75% level. All right, to help you find something known as that fair value gap or moving into higher time frames, which we will eventually get into. Now, moving forward, there is a third retracement or a third pullback in the level, and this is a 100% retracement. This is where the market retests the entire previous swing low or swing high of that zone. This is where the trade or the market completely bottoms out in the market, then going in the direction of the market. All righty. And this can have everything to do with institutional order flow and market manipulation as well. So let's take a look at a different example of a 100% retracement in the market. So here goes a 100% retracement. If we take a look, we can see that the market was creating new highs and lows in the market, right? And then what we can see here is this market created a level of support. And as the market pushed up, it created a new level of resistance right over there. So now we have identified a trading zone in the market. Now, what ended up happening here is the market broke this previous low. Again, that's the first sign of a market structure reversal. Now, once the market breaks a previous low, the market is going to look to pull back or to retrace. And as long as the market, remember, market structure rule 2 is that as long as the market stops and reverse anywhere in this area without creating new highs, which is up here, that's going to be the second sign that the market is going to begin to come back down. So in terms of where the market is going to retrace, shallow retracement, standard retracement, deep retracement, but in this example, we had a 100% retracement right here in the market. This gave us a 100% retracement in the market before pulling down like that. So that is what a 100% retracement looks like. And again, as you guys develop your price action concepts and how you begin to trade the market, your strategy can very well depend on one of these 4 type of pullbacks inside of the market, or maybe you're going to be able to become extremely educated in this market and just understand what zones, what levels, and at what times the market is going to pull back to these levels, and how to use a combination of different technical analysis tools to be able to confirm, okay, this is the definite area I want the market to pull back to. All righty. So these are all the different pullback and retracement levels inside of the market. Now, moving forward, let's talk about something known as price reversal zones. Now, this is going to be extremely helpful to you guys, especially when it comes to entering in the market. Now, a price reversal zone is cited as a specific price zone that exhibited previous price rejections on both sides, validating the likelihood of a market reversing at this zone. Now, this is incredibly important as PRZs, price reversal zones, are going to help you determine some of the most important information that you need to see and isolate in the market. So 1, price reversal zones are going to help you identify stronger levels of support and resistance. As example, looking at this diagram over here, if the price was downtrending, we can see that price established a level of support and there was price rejection. So the price stopped and reversed and went up. Now the price eventually broke through that level But when price returned to that level, this new support, this established level of support became a new resistance. And when price came back to this level, it did not disrespect the level. It did not break through the level. It actually stopped and reversed and solidified that this is a valid level of resistance. This was a valid level of support. Okay. Now, as the market pulled back and came back to it one more time, you can see that it's now a stronger level of resistance. The likelihood of the market reversing at this particular zone is a lot stronger than any old, support or resistance based on a higher low in the market. It's considered a price reversal zone because there was previous price rejections on both sides of that price level. This is extremely key to finding good levels in the market. So this helps create stronger levels of resistance and support, which will give you more confidence to trade off of those levels. Now, PRZ zones are also ideal levels for break and retest in the market. So as an example, we were just speaking about break and retest. So once the market breaks through a price reversal zone and the market pulls back and gives us a retest, as we can see here, here's the breakout and retest. This can be an ideal level. This price reversal zone can be an ideal level to buy back up in the market because of the level's validity. This is a very, very valid level. All right. Now, before we talk about the signs of the market and trend reversals, let's come back over to the market and then let's look for certain zones. So if we take a look at, let's say, this zone, let me come over here. Let's draw a full horizontal line across the market. Let's take a look at this horizontal line. Let's make this horizontal line black. We'll make it thick. We could, let me see here what's going on. There we go. Let's make that 4, make this black. All right, let's look at this particular zone. Now, if we look at the zone, I want you to look at this zone. Can you guys see on this particular zone? Let's draw some downward arrows right over here. We can see that the price was rejecting at those zones, right? There was good price rejection at those zones. While at the same time, there are also good price rejections to the upside on those zones, right? So if we take a look, let me unlock this. If we take a look at this particular level, again, there is price rejection on both sides of the levels. So this would be considered a price reversal zone in the market. This is a price reversal zone or a specific price level that you want to ideally pay attention to. Why is this important? Because if you look in the future, let's take a look right over here. What happened when price, let's take a look. Give me 1 second. Let's delete this. Let's delete all of this. Let's look over here. Look at how this market had a low and how this market had a high. And this market, in fact, broke out. Do you see that? Very small. We have a little trend over here. The market broke and retested trend, potentially coming down. The market is making series of lower lows and lower highs. That's a higher time frame analysis. Let's take our Fibonacci's from high to low. And we come right over here. And what do we see? Remember, a standard breakout can be anywhere from 1/3, the 32, to 2/3, the 618 of a move. And ideally, a standard retest will come back to the previous price breakout level. So look at how this was the price breakout level. Look at how the market pulled back up to that level at around 50%. And from that area, the price, in fact, dropped off a staggering amount of over 40 pips in the market within a 1 hour time frame. right? So you see price reversal zones are extremely important. If we take a look over here, we can see, let's actually remove some of these drawings. If we take a look over here and we look at this market, that high in this market, before the market, let's show you here one more time, before the market broke and retest the zone, we can see that this was not a standard. This was not just any old support and resistance zone. We can see that there's a very, very strong price reversal zone over here. Look at how there were multiple hits over here. Price rejection, price rejection, price rejection before the break and the retest, helping us signify that this is a valid price level to enter in the market. All right, so price reversal zones are very, 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 very powerful. They serve as stronger areas of support and resistance. They are ideal levels for break and retest. And most importantly, PRZ zones are the first sign of market and trend reversals on higher time frame. Remember, as discussed on our FRX Bootcamp 2, the concept of multiple time frames and analyzing. So as an example, let's say I want to come over to a 4-hour market, okay? Let's say I come over to a 4-hour market. 1 second here. Let me delete these arrows. Let's say I'm coming over to a 4-hour market. I can use a 4-hour market to help me determine price reversal zones for a larger time frame. All right? 1 second. Let's delete this. So let's see where we can find stronger price reversal zones over here. And I want to find something very clean and very clear. We can actually go ahead and use this as a strong price reversal zone right over here. I wanted something even more to the T. I want something even more to the T over here. Okay, I wanted something even more to the T, something even stronger to see. But for now, let's just use this. So we have 1, 2, we have rejection right over there. And as we extend this to the future, what can we see over here? While we have price rejection on one side of the zone, we have price rejection on the other side of the zone. We can even make this even thinner if you want. Let's take a look. Right? We have price rejection on both sides of these zones. Price rejection, price rejection, price rejection, price rejection, market pulls back in, price rejection, price rejection. So we have some very, very strong price reversal zones. Now this is the 4-hour. So just like how it would do it on a 5-minute or 15-minute, as stated, if the market is returning back to this level on a 4-hour, okay, this is letting us know, well, right at this level, we might see a price reversal. So let's come down to the very first time that price hit and ran into that price reversal zone. And what do we in fact see? We see that the price came right back over here on a smaller time frame, established the level, low and high. Let's bring that out, establish the level, and began to create a market structure reversal and begin trending down. And then the market did it again. And look at over here. Now on a smaller time frame, we had the market breakout, and we have the market retesting, coming right back over there. Now going back down in the markets. So I hope you guys are able to see how price reversal zones not only play a role on a smaller time frame, looking for strong areas of support and resistance and giving us areas of breakout and retest, but you can use this in confluence and in combination by going to higher time frames, looking for price reversal zones and understanding that when price returns to that, you can now look for a bigger move in the market doing so. And that's exactly what we stated down here. Price reversal zones are ideal areas for market structure reversals to take place. All righty. It's not a typical support and resistance as we see over here. There is a major market reversal happening. Now, moving forward, let's begin to talk about entry points in the market when it comes to price action trading, because there are three common areas of entry. And this has everything to do with support, resistance, exactly what we're talking about. Pardon me over here. This has everything to do with support and resistance, pullbacks, retracements, the concept of break and retest, and identifying price reversal zones. They're all one and the same. So let's dive into entry points inside of the market. Entry points refer to price at which a trader enters into a trade, whether a buy or sell. The entry point is usually the result of a predetermined trading strategy or a series of confirmations which minimizes the risk to reward ratio. A good entry point is often the first step in achieving a successful trade. Now, your entire career as a trader, you're going to be looking for entry points in the market. What's the best entry? As you're trading along with educators within IM Mastery Academy and strategy specialists within IM Mastery Academy, and they're identifying zones that can be good areas of, good potential areas for entry. Your entire career as a trader is going to be predetermined by your entry points. So I'm going to read this one more time. Entry points refer to the price at which a trader enters into a trade. The entry point is usually the result of a predetermined strategy, which means as you're trading with myself or other strategy specialists, we typically have a strategy. We're following the strategy, or we're following a series of predetermined confirmations to identify an area of entry. So all the work, the strategy, all the steps is to just find that one magical point in the market where we can enter, we can set it, and we can forget it. Because the result, the positive result of a good strategy and getting an entry point will minimize the risk to reward ratio. Meaning, as discussed in our previous masterclass, meaning that when we enter the market, our risk would be significantly lower to our reward, because we are expecting at this particular price, at this particular moment in time, for the market to start moving in our direction. We're not waiting for the market to swing 20, 30, 40, 50 pips in drawdown 1, 2, 3 days later to then go in our direction. We're looking for a calculated point in time, a calculated period, which is time in time, where the market is going to make a move in our direction. And that's the predetermined result of a trading strategy, which is why you guys want to master the strategies I'm providing, or the strategies the other IM Mastery Academy educators are providing, because this is going to often be your first step in achieving a successful trade. Now, the three most common areas of entry, not limited to, but the three most common areas of entry is known as the E1, the E2, and the E3 trades. The E1 trade is a pullback to an equal high or low in the market. All righty, a pullback to an equal high or low in the market. And this is where you are essentially trading liquidity inside of the market. And this is a great, great way to trade once you have identified how to trade equal highs and equal lows. So let's come on over here and let's look at two E1 entry points right over here. Remember, E1 entry points are determined by equal highs in the market. An equal high is a pullback to a previous high or low in a zone. So if we take a look, we see that the market has a lower high, lower low, lower high, lower low coming in a downtrend. From here, the market pulls back one more time to a lower high. And now the market pulls back and it stops. It doesn't continue. It stops and it begins to accumulate And now you're having a moment in time where you could say, okay, is this market going to go up? This is considered an equal low because it pulled back to the previous low point in the market. That is an equal low. And if the market stops in reverse from here and begins to rally, you're now getting into a liquidity trade. And the same over here. Look at the E1. If the market pulls back to the lower high for the very first time and stops in reverse, this is an equal high. That's an E1 trade. As an example, if we come, where are we? Let's remove these drawing tools. Let's come back to what we're looking for over here in the market. Okay. Let's look for an equal low. If we look over here, we see the market had a low point. The market had a significant low point, and we can see that the market returned back to this low point, and now we're potentially buying up from that low point. Where are other low points? The market created a low point. The market returned to that low point, giving us an equal low, and the market went up. The market created a high point, hit the high point, and came down. But do E1s always hold? No, because essentially it's almost like trading support and resistance. It just depends on how you are trading it. Like, look at here how the market had a high. Market went from high, low, high, equal low, did not create new lows. Market turned up, went into profit. But as the market ran to this previous high, did the market stop in reverse? No, it did not. The market simply broke right through, broke out that equal high, letting us know, well, the market wants to keep going in an uptrend. All righty. So that's the difference of identifying equal highs and equal lows. You want to see the market stop and reverse at that area, begin to accumulate, or look for other factors to determine an equal high, equal low pullback. All righty. Now, an E2 is is a breakout of the current high or low. This is known as the break. This is known as the breakout. Okay, so the breakout of the current high or low, and this is where you are essentially trading momentum in the market. So if we come back over here, let's look for a breakout. So if we see this over here, we have a breakout. If we look over here at these lows right over there, we have a breakout trade. Okay, anywhere where price is breaking out, we'll come over here, we'll put this blue. Anywhere where price is breaking out the high, that is a breakout. Anytime price is breaking out the low, that is a breakout. So those breakouts are not just ways that you can identify to see what the market is doing. If you're reading the market correctly, this can also be a trading idea for you as well. This is known as a breakout trade. When you've identified a very, very good breakout trade and a good breakout opportunity, you are essentially trading momentum in the market. This is where you, the banks, the economic news, everything is just pushing the market in one direction. The market clears that low, that candle clears that low, baby, and it keeps on going in the direction that you're looking for it to go for. Okay, that is an E2 entry, the breakouts, okay, of the current high or low. So as an example here, the market is bouncing around between these areas of support and resistance, giving us E1 entries, giving us buy and sell opportunities at equal highs and equal lows. Eventually, the market breaks out the resistance and continues to go up. And when the market breaks out on either side, that is considered an E2 entry point. Now, an E3 entry point within the market is the retest of the previous high or low inside of the market. All right. The retest is, as we just discussed, which is the break and retest of particular zones that we just thoroughly went through. So the E3 is simply the break and the retest of a zone on any side of the market. Now, do not quote me to this because I really statistically and analyzing the market, I don't know if this is the proper term, but I believe When you're doing a break and retest, you are trading the volume inside of the market. Okay, the volume is the amount of buy orders that's beginning to accumulate, and how many buyers or sellers are getting into the market to take the market back in your direction. And that's because the market has to break out, it has to pull back down, retest, and then it has to reaccumulate new orders and new buyers, and then the market begins going in your direction. So if you analyze that correctly, you're trading the volume, and then you're getting that increase inside of the market. Okay. So because it's liquidity, momentum, volume, volatility, things like that. So this is definitely not volatility. This is more of a volume-based type of trade. So that's your E1, E2, and E3 entry. And as you're looking, okay, one more time, let's come over here. Let's look at this trend. As you're looking in the market is going to be doing the same thing all the time, right? So let's take a look and let's do a few examples here. Market creates a high. Whoops. Market creates the high. Market creates, let's lock this. Market sets the low. Market returns back to the high. That's an E1 pullback, an equal high pullback, opportunity to trade if you're reading it correctly. Market pulls back down to the equal low. We see the wick. If you read that correctly, you can get in the buy back up. Eventually, the market is going to want to break out from this low. You see that big breakout candle right there closing below the low. Boom. That is an E2 breakout. That's an E2 entry where the market is now breaking out of that zone and giving us a push down inside of the market. And then the market will continue. So as we come over here, again, the market could have broke out on either side. Now, as the market breaks out and pulls back and gives us a retest, this is a standard retest back to the level, which is 1/3 to 2/3 of the movement. That is now an E3 market. And the market is going to do it again. It creates a high, it creates a low in that particular zone. And now what are you doing? Equal high, equal low, right? Am I going to trade the equal low there? Am I going to trade this equal low down there? Am I going to trade the breakout of the low right over here? Is the market going to break out and then give me a retest, which is there goes a deeper retest? Is the market going to give me a deeper retest inside of the market and then continue? Okay. So when you're reading price action, you're doing price action, again, it is a continual series of the same thing again and again and again and again. And we are simply reading and interpreting the data of the market, and we're just like little guppies feeding off the banks. And if we read this correctly and we trade this correctly, we're just going to be trading in the direction of the banks and making money along the way. That is the purpose of price action. All right, so there goes your E1, E2, E3. There goes your three most common areas of entry: the E1 entry, the E2 entry, and the E3 entry. Now, please remember that every strategy has a unique method of entry, and entry points may vary. So just because this is the three most common areas of entry where traders are looking to enter the market, this does not necessarily mean that every single strategy around the world is going to be based on these three common areas of entries. Some traders, some strategies have different type of concepts of what their entries are going to be. So please remember, as you begin to master your strategies, master the entry, because that's exactly what the strategy is based on, is finding a predetermined, right? Every strategy is looking for the entry point, and that's the predetermined result of the strategy. Okay, so quick important note before we move on: entry points and market analysis are not to be confused because they are different. You analyze first and you enter second, meaning just because the market pulls back to an equal high and you're saying, hey, this is a E1 entry, we have an equal high, that does not mean that that's an automatic trade idea. Just because the market breaks out of a high does not make that an automatic trade idea. Just because the market pulls back to a retest level does not automatically make that a market idea. Everything begins with an analysis. An analysis, again, is the way that you are reading and interpreting this price, meaning that you want to see it come back to the E1 and then see things happen before you trigger. You want to see the market break out and see a combination of certain things in relation to the breakout to really take the entry. You want to see the pullback to the zone and get more confirmation of certain things that's going to allow the market to go. So you always analyze first and then you enter second. All righty. Now, moving forward, as we get ready to start winding down this FRX Bootcamp Part 3, we're now going to begin to talk about supply and demand levels. So we cannot talk about support and resistance without speaking about supply and demand. So let's just talk about this. Supply and demand zones, also known as accumulation and distribution zones, are insanely powerful price indications. Due to the sheer amount of liquidity at these particular price areas, liquidity means all of the buyers and all of the sellers, all of the money that is trapped at that zone. That's what liquidity is, right? It's a bunch of money trapped at a specific zone. Due to the sheer amount of liquidity at a particular price area, these two zones are often the most critical levels on the chart and probably the best levels to trade after they are created. So basically, supply and demand levels are support and resistance levels on steroids. They're stronger, they have more money in them, and bigger moves are happening from these supply and demand levels. And you most definitely want to learn how to trade with supply and demand in the market. Okay. So determining supply and demand levels, you can determine what a supply and demand level is based on 4 different factors. So the first factor of a supply and demand level is basically price accumulation. Okay. Sometimes you might not notice a supply and a demand level right away, but as you get better at trading within the market, you'll be able to determine a supply and demand level based on the accumulation that is happening at a particular price zone, and we'll dive into that. Now, the telltale signs and factors of a supply and demand level after they have been established are: there may be a cluster of wicks in that particular zone. You will see very, very large banking candles leaving from those zones. And you also see large or fast volatile moves happening from these particular levels. All right. So we're going to go into looking at supply and demand levels. Now, let me read this off the chart. Trading supply and demand levels can help improve your odds of winning, since large institutions require large amount of liquidity to enter in the market. So you get to use this to your advantage. I'm going to say this again. Trading supply and demand can help improve your odds of winning, since large institutions, banks, hedge funds, corporations require large amounts of liquidity to enter in the market. Meaning that the banks, when the banks are entering the market, they're causing these big, drastic, radical moves in the market, which are making the market move hundreds and hundreds and hundreds of pips at a time. And many a times when you're trading a supply and demand level, you're simply trading in between the zone, which we're going to get into. You're typically trading in between the zone of a supply and demand level. All of the support and the resistance happening in between the supply and demand is chump change. That is retail traders, people like you and I, that's buying and selling, creating these movements. The banks, buying and selling against us, just basically creating these zones and moving the market around. And then we're using the smaller levels, which are the support and resistance and trends, to help us trade in the direction the market wants to go. The market is going to want to go in the areas that the banks want the market to go. You're able to understand the direction the bank wants to go by isolating and learning about supply and demand levels because you're learning institutional order flow. So essentially, look at it like this. Let's remove all the drawing on the chart and let's go up to the daily, right? While we're trading on the 1 minute, the 5 minute, the 15 minute, and the hourly, looking for the moves to go high and low, the banks, corporations, hedge funds, they're trading the market on the daily, the weekly, and the monthly time frames because they cannot enter the market without the market just making a drastic move. And that's why all the banks and the central banks, they work together, they move together inside of the market. So a higher time frame analysis using the 4-hour, 8-hour, daily, weekly is going to help you determine supply and demand zones inside of the market. And then you get to go ahead, drop down on lower time frames and trade within these zones or trade off of these zones, which is going to help you increase the odds of your trading. So let's talk about how to identify supply and demand zones in the market. So looking at USD Chef, again, one thing that you'll notice is that there's going to be something known as price accumulation and cluster of wicks. So these are the first two ways that you can help identify if an area is going to be at a level of supply and demand, because there are, in fact, supply and demand strategies that you can trade in the market. But let's just look at determining supply and demand levels so that way we can potentially enter them when we get back to it. Okay, so let's come over here. All right. So first thing that we're looking for, again, one more time, I'm so sorry, is price accumulation in a particular zone. So price accumulation is basically where, let's look right over here, is where price on a higher time frame and a cluster of wicks, let me get rid of this, is where price on a higher time frame is basically just accumulating, going back and forth, creating a basically like a consolidating range or a consolidating market. So if we take a look on the daily right over here, what can we see? We see a cluster of wicks, wicks up, wicks down, wicks down, wicks down, wicks ups, basically in a very flat, even range right here in the market, right? So we see the cluster of wicks and we see this price accumulation happening right over there. Okay, let's come down here. It depending on where you're looking for supply and demand and how you're trading it, it could be very, very confusing, but it shouldn't be. So anyway, that's one way to determine supply and demand, looking at the cluster of wicks and the accumulation of price in an area. Like as an example, this is actually another zone right over here. We have a very, very strong equal zone, lots of wicks, market moving sideways. This is a potential demand zone. Okay. Now moving forward, let's talk about the other things that make it more noticeable to you. So if you're looking to trade a supply and demand strategy, price accumulation and cluster of wicks is really what you want to go for. But if you're looking to simply just identify supply and demand zones, you can also just look for large candles or large, fast, volatile moves from the zone. As an example, right? We can see here from this zone, we had a large supply candle, which means on the daily, we had a huge drop off right there in the market, leaving that zone. And not only did we have that huge drop off, but we had a long, fast move. Look at, we have days, 1, 2, 3, 4 days of pure dropping off in the market. That's a large, fast move. If we look over here, it's the same thing. Before the market began to go up, we see a large candle right over there. We see another large candle right over here. And what ends up happening, we get a large, fast, volatile move leaving from that area. This can help us determine supply and demand zones. Now, why is it important to determine supply and demand zone? Well, that's because on, let's say on a daily, well, this now becomes something known as your trading range, okay? And the banks are trading in between this zone, all righty? Boom. Now, if we look over, let's look over here. Let me try to come back over here and look for other examples over here in the market. I'm going to come right over here. Let's try to take a look. We have a very strong zone, but that hits in and out. Let me try to come over here. Let's try to look at some other different type of supply and demand zones. Now, I'm only struggling here because supply and demand zones, you know, they're creating and then they're kind of blending in with the market because the market is already taking place. So I have to see the supply and demand zone and then train you on it, right? So as an example, let's say I do a market replay and I do something like this in the market, okay? Now here is some good stuff over here, okay? So anyway, let's come back over here and then let's look over here. We have an accumulation of wicks and a large candle that leaves that area, right? We have an accumulation of wicks, large candle that leaves that area, okay? Accumulation of wicks, large candle that leaves that area, okay? So let's use these. So if I pull these out, bingo. If I pull that out, bingo. If I pull this out over here, bingo. What you're going to notice from these particular zones, now mind you, this is on the daily, but what you're going to notice from these particular zones, okay, these two are the best zones. What you're going to notice from these different zones is that as price returns to these zones, look at how we're getting big moves away from that zone. Look at how we're getting big moves away from this zone. The market comes back into this level of supply. We have a big wick and a huge drop off over here. Market returns to the zone. Boom, big candle, fast drop off. Market returns to the zone, lots of wicks, something else is happening. Boom, big drop off. Wicks come back, big drop off. Market comes back, big drop off. Market comes back again, big drop off out of those areas. So you see, this is a very, very, very important price in the market. So this is where banks are looking to trade. So you want to make sure that you are identifying supply and demand zones when trading inside of the market, right? And as we can see right here on the daily, we have potential demand zones up there, potential supply zones over here, and we have potential demand zones right down there in the market, right? Essentially giving us a very, very large range right over here. But these are the areas, let's come back over here. Let's look at this supply and demand price reversal zone right over there. Okay. Now, if we end up looking over here, right now we have a very, very large area, guys, a very, very large area. You have a supply and demand price reversal zone over here. So you know this is a valid, you're going to be looking for some type of reaction when the market comes back over here. And now down here, based on this huge one, let's go to the 4 hour. Let's look for that cluster of wicks. There we go. Let's, if you want to mark that up, let's look for that cluster of wicks right down there and that big candle. You can probably do it like that. Bingo. Let's get rid of that. We'll get rid of this. And we'll get rid of this. I'm trying to teach you supply and demand without teaching you a supply and demand strategy. That's so funny. Okay. All right. So there we go. Now you have successfully identified the demand and you've identified the supply. Now that you've identified it, you know that if the price moves back here, you can expect a huge move. And if the price comes back up here, if the price comes back over here, you can expect a huge move as well, right? This is supply and demand. Now, coming back over here to supply and demand, let's talk about trading zones, because you can't speak about one without the other. A trading zone is a large range in between the current supply and demand zone, which is exactly what I just showed you, or the most significant recent swing zones, swing points in the market. Okay, in case you're not losing supply and demand, zones can help traders identify the current order flow of the market to assist in their trading analysis. Determining trading zones, you can do things like the swing points on higher time frames. So if I come over here, let's try to identify different swing points. So let's come to a higher time frame. We're on a 4-hour time frame. I mean, we have a really, really good swing point, but let's say you want to create a smaller zone. Here goes the swing high. Here goes the swing low. Right over here in the market, let's see if we have some valid PRZs. We have some valid PRZs over there. Let's see if we have some valid PRZs over here. We have some valid PRZs right over there. So now the traders may determine and say, hey, this right here, this is now my trading zone. So I'm going to shoot down. So let's say the 1 hour, the 15-minute, and I'm going to be looking to trade inside of that zone. That's one way to determine the swing zone. Okay, you can use the high or the low of the day or the week to determine swing zones. So you'll notice that some traders, let's get rid of this. Some traders will look for where the day, let's come over here. Let's look for the high of the day. Let me see, or let's do it from yesterday. So today is the 16th. We'll move back, 16. Boom, right over there. And then let's come back from 16, 15. Let's go back to where's 14. 1 second. Is there a gap? That's the gap because there was the weekend. All right, so that kind of throws us off. So let's look at before the market closed, which was the 13th when the market opened. Like, I can't. All right, that's messing me up a little bit only because of that. So anyway, anyway, that's the high of the day. Let's just come to the low of the day, which was down here. We'll just use this day. I was going to try to use the pass. So anyway, so there goes the high of the day. There goes the low of the day, right? So if we end up opening this up, let's say we come down to the 15-minute, okay? Using the high and the low of the day, some traders may use the high and the low of the day as their ranges inside of the market, right? So if you're a day trader, here goes the high and then here goes the low of the day. Now look at how price returns back to the high, getting some type of retracement and rejection and things of that nature. And you could do high and lows of the days. You can do high and lows of the weeks. And this can really help you identify as you begin to do your session breaks and things of that nature. This can also help you determine the order flow of the market as well. All right. I'm trying to just be short on the training for the preservation of time. Now, you can also use current supply and demand levels inside of the market, which is what we are using right now. As you can see, we have current supply and current demand zones as our trading zones inside of the market, right? This entire zone is our entire canvas. This is where we're looking. We're either looking for the market to come back to this low, or we're looking for the market to come back to that high. All righty. And there are other tactics that traders deem fit to create their levels. Some people use supply and demand. Some people use quarter levels. Some individuals use key levels. Like as an example, I myself use key levels inside of the market. So I have predetermined key levels, which helps me understand my trading zones inside of the market for different type of pairs. And I trade off of that. Okay. So coming back to USD Chef, let's come back over here. Okay. That gives us our different key levels. All right. So trading zones can play an important role in your trading. Again, use higher time frames to your advantage when looking for trading zones. All right. So in this example of USD Chef, or in the example of, I guess I was on another pair, which was what, USD CAD. No, it was USD Chef. So in the example of USD pardon me. In the example of USD Chef, I have my highs, I have my lows, and what is it that you think I'm doing? Let me give you an example. When I'm talking about understanding order flow, is this. The market goes from low, market hit a high, market pushed back down to a low. On a higher time frame, I have found an area of demand inside of the market. And now I may very well look to see this market push up to this next area of supply. So this is the trading zone. So I am now going to be trading inside of this zone, which means my support and resistance levels are going to be based off of this zone's highs and lows. My trends, my intraday trends for the days or the weeks are going to be determined by what's happening over here. My analysis is all happening in here. So am I determining that to go up on this time frame, or am I determining this to come up on this particular time frame? Am I looking for this market to come down over here? And if we take a look, you begin to use price action concepts. What can we see? We see that the market is trapped between a supply and demand zone, and price is beginning to contract between these counter trend trades. One trade's going up, one trade is going down, and we're using key levels and price zones and things of that nature to develop, some type of trading analysis. All righty, ladies and gentlemen, so let's remove all of these drawings. Again, this is me being as general as I can without training on any specific strategies. I just want you guys to be able to understand the concepts of price action and using everything we have here. So this is going to go ahead and conclude our FRX Beginners Bootcamp Part 4. On our next FRX Beginners Bootcamp Part 5, we're going to begin to dive into indicators, things like Fibonacci's, talking about zones, market pullbacks, corrections, extensions, different type of indicators that you can use in the market as well. And the Fibonacci will be your biggest tool to help you understand your price action pullback. So be sure to tune in for Beginners Bootcamp Part 5. So just going to recap Bootcamp Part 4. What did we discuss in this bootcamp? Right? We introduced the actual concept of price action and understanding how price action is a method of trading that allows traders to read the market and make subjective trading decisions based on recent actual price movements to generate signals of entries and exits in the market that stands out for its reliability and not for requiring the use of an indicator. And we use price action. A combination of things that we use for price action is determining highs and lows, support and resistance, trends, and there are a variety of price movement concepts which we're not discussing here to keep this general. We talked about support and resistance, how to identify support and resistance in the markets, and how that can visually help us understand the directions of the trends in the market. We've also talked about pullbacks and retracements to a point where you're understanding how as the market structure is carrying price to highs and lows, how they're breaking into new highs and lows and pulling back in these zones, and what they essentially look like, what those pullbacks and retracements look like. Then we discussed the concept of break and retest when it's pulling back to those zones, how you can understand these pullbacks, how you can understand these retracements as the theory of breakout and retest, and the 4 different type of pullback and retracement retest levels that exist in the market when it comes to helping you predetermine an entry. In addition, we spoke about price reversal zones and how to find particular zones in the market that exhibit certain features of price rejections on both sides to give us stronger areas of support and resistance, that give us strongest areas of supply and demand, so on and so forth. In addition, we spoke about entry points and the three most common areas of entry, which are the E1 pullbacks equal high and lows, the E2 entry, which is the breakout of current high and lows, and the E3 entry, which is the retest of higher lows, but also understanding while these are the three most common areas, every strategy has a unique method to enter inside of the market. Then we discussed supply and demand zones, which is the bank's support and resistance levels, which can help you improve your odds of trading, helping you understand the market on higher time frames, understanding the order flow of the market and how to determine these supply and demand levels, which we're going to get deeper into. And then how these supply and demand levels create trading zones for us and how we can trade within those trading zones using these various price concepts within the market. All righty, ladies and gentlemen. So one more time, I want to thank you guys so much for tuning in with us for the Forex Beginners Bootcamp. My name is